So you did it. You picked a winner, you made the right call, and that investment paid off. It's an amazing feeling, right? But there's always a catch. And that catch is called capital gains tax. The big question is, how do you protect what you've earned? Because really, it's not just about what you make, it's about what you get to keep. Yeah, that's really the heart of it, isn't it? Making a profit, that's only half the game. The other half, and this is what separates the pros from the amateurs, is knowing how to legally and strategically keep that tax bill as low as possible. It's all about understanding the rules so you can really truly capitalize on your win. Okay, so where do we even begin with all this? Well, believe it or not, every single strategy we're about to talk about, it all comes down to one core principle baked right into the tax code. If you get this one thing, everything else just clicks into place. And here it is, the big one, the difference between short-term and long-term gains. If you sell an asset in under a year, that profit gets taxed at your normal income rate. You know, the same high rate as your paycheck. But if you just hold on to that exact same asset for 1 year and 1 day, everything changes. It becomes a long-term gain and the tax rates drop way down. We're talking 0, 15, or maybe 20%. It's a huge difference. I mean, just think about what that really means. The tax code is literally giving you a roadmap. It's designed to reward patience. Time is probably the most powerful tool you have as an investor. Holding on for just a little bit longer, sometimes just a single day, can save you thousands of dollars. The system is telling you it wants you to invest for the long haul. All right, first up, let's talk about strategy number 1, and it's all about deferring your gains. The idea here is simple. Why pay taxes today if you can legally push them off until tomorrow? This lets your entire chunk of money, the pre-tax amount, keep growing and compounding for you. It's a powerful concept. Now, if you're a real estate investor, you absolutely need to know about the 1031 exchange. It's a total game changer. It comes from, you guessed it, Section 131 of the tax code, and it lets you sell an investment property and roll 100% of those profits into a new, similar property without paying a dime in capital gains tax at the time. So how does this magic actually happen? Well, you gotta know, it's a very structured process. First, you sell your property, but, and this is the key part, you never actually touch the money. It goes directly to what's called a qualified intermediary. Then, you have a very strict deadline to find a new like-kind property, and the intermediary sends the funds to close the deal. And just like that, you've kicked that tax bill way down the road. And this is where the real power of the 1031 comes in. People in the industry have a saying for it, swap until you drop. Because this isn't just a one-time trick. You can do this again and again and again, swapping from one property to the next for your entire life, letting that portfolio grow and grow, all on a tax-deferred basis. Okay, so putting off taxes is great, but what if you could just get rid of them completely? Well, that brings us to our second set of strategies. Because in certain situations, the tax code actually lets you wipe out the tax on your gains entirely. You know, this might be one of the single most powerful tools in the entire tax code when it comes to building wealth across generations. It's called the stepped-up basis. Basically, when you inherit an asset like stock or a house, the government says, forget what the original owner paid for it. For you, the new cost is whatever it's worth on the day they passed away. Let's walk through an example to make this super clear. Let's say your parents bought a house for $100,000 a long time ago. Now it's worth $600,000. When you inherit it, your new cost basis is $600,000. So if you turn around and sell it for that price, guess what your taxable gain is? 0. That's $500,000 of appreciation that is never, ever taxed. It's incredible. Okay, but you don't have to wait for an inheritance to eliminate gains. For homeowners, this is one of the best deals around, the primary residence exclusion. If you're married, you can make up to $500,000 in profit on the sale of your main home, and it's completely tax-free. The main rule you have to follow is you've got to have lived there for at least 2 of the last 5 years. And what about your stock portfolio? Well, this is where accounts like a Roth IRA become your best friend. Anytime you buy or sell investments inside a Roth, there are no capital gains taxes, period. All that growth, all the money you take out in retirement, it's all 100% tax-free. It's a fantastic way to build a pot of tax-free money for your future. So, we've talked about deferring and even eliminating gains. But look, sometimes you just have to sell, take the profit, and pay some tax. It happens. So our last set of strategies is all about one thing: making that final taxable number as small as possible. This brings us to a classic move, especially around the end of the year, called tax loss harvesting. The logic is actually really simple. Look, every investor has some stocks that went up and some that went down. The idea here is to strategically sell those losers to harvest the loss. You can then use that loss to cancel out the gains from your winners. You're basically turning your portfolio's lemons into tax-saving lemonade. Here's how that plays out in the real world. Let's say you sold stock A and made a $10,000 profit. Nice! But you've also got stock B and it's down $8,000. Well, if you sell stock B, that $8,000 loss directly wipes out most of your gain. Now, instead of paying taxes on 10 grand, you only owe tax on the net $2,000 profit. It's a really smart way to manage your bill. And sometimes the most powerful strategy is also the most straightforward one: relocating. If you're looking at a huge capital gain, moving could be a serious game changer. States like Florida, Texas, and Nevada don't have any state income tax or capital gains tax. Zero. For a really big sale, a move like that could literally save you 6 figures that would have just gone to state taxes. Okay, let's zoom out for a second here. All these individual tricks and strategies are great, but they're most powerful when they're not just one-off moves, but part of a bigger mindset, a totally different philosophy on how you approach your money. You see, the most successful investors aren't just winging it. They're thinking about their exit plan before they even buy an asset. They're stuffing as much money as they can into tax-advantaged accounts. They're not thinking about next year, they're thinking about the next decade. And most of all, they see the tax code for what it is. Not just a bunch of annoying rules, but a set of incentives pointing them towards smarter decisions. And I want to be crystal clear about something here. This has nothing to do with tax evasion. This is all about smart, legal, strategic tax planning. The wealthiest investors aren't paying less in tax because they're cheating the system. It's because they've taken the time to learn the rules of the game better than everyone else, and they use those rules to their full advantage. So I guess I'll just leave you with this one question to think about. Is your financial plan all about just earning money, or is it about strategically building it and, just as important, protecting it for the long run? Because honestly, the difference between those two mindsets, well, that's everything.